Good morning. Today is Thursday, September 8th. I hope you are doing well. We have a lot to cover today. Took a long time getting this ready today, so we're just going to jump right into it with central bank policy. Right now, the Japanese are concerned about a weak yen. The vice finance minister said that in the 2 days of September 6th to 7th, the currency has fallen by around 5 yen to the dollar. Fundamentals alone can't justify these moves. At the same time, the Bank of Japan governor is very obstinate in keeping interest rates exceedingly low. So you can't really balance that out. How do you keep rates extraordinarily low in a global environment where rates are rising, where other central banks are tightening policy, and you're continuing to print all this money to keep rates low? Of course, your currency is going to weaken. Now, should it weaken 5 yen to the dollar overnight or over 2 days? Probably not. But they don't rule out intervention in the FX markets, which would be presumably to strengthen the yen relative to the dollar. So something to watch. But if oil prices are going up here, it's going up to that degree more when priced in yen. So I think that's something to watch going forward. The ECB met at 8:15. Tom, talk to us about what is going on with that.
So they went ahead, they raised 0.75%, so 3 hikes this morning, which was anticipated, and they expect to tighten further over the next several meetings. What continues to be the thorn in my side with the ECB is their inability to look at the world as it is, which is to say that they actually upgraded their expectation for GDP this year to 3.1%. So they're saying they're going to have more growth, I'm assuming in Q4, to cover that gap, and actually be in an expanding economy. And then for next year, they're looking at 0.9% as the total growth. So they're basically saying that they're going to grow into the end of the year and then basically hit a stagnant point in their economy, when I think the realistic view is that they're not going to hit that 3.1% this year, and then they're not going to hit that 0.9% and probably see a recession next year. Though they have been very specific, saying they're not seeing a recession on the horizon for the Eurozone. In terms of their inflation expectations, they bumped up the full year for this year to 8.1, which I think at the middle of the year, they said it was going to be 4.1. So they moved it from 4.1 to like 5.5. And now they're saying it's going to be 8%, which duh. But at least that part is normal. They're saying, in the 5 to 5.5% range for 2023, and then moving down to 2.3 in 2024, which is actually a little bit of a bump up. They had 2.1 as their expectation earlier this year. So they're basically saying, we're going to raise rates, we're going to be aggressive, and that's going to have a massive effect on inflation, and it's going to come down over the next 2 years. And there's basically zero chance that that's going to cause a recession in the Eurozone, which I think what they're trying to do is speak it into existence, not panic anybody by saying, realistically, we're probably going to be in a recession as early as Q1 2023. But instead, they're going to say, we're not going to be growing. We're just going to be up just a tiny bit, which is not a recession. We're basically going to go from growth to neutral and then back to growth, as opposed to we're not really growing to we're contracting back to growth. And so I think those are the main takeaways from the meeting this morning.
Yeah, for behavioral finance people, anchoring bias is a real thing, and no one falls victim to this more than central bankers, because you don't want to make a big call. You think that things generally mean revert. There's a lot of noise in the economy that tends to offset. So you essentially just go with the central tendency. I mean, even the forecasts themselves are the central tendency of an amalgamation of a number of economists who are on the ECB. Same with the Federal Reserve. I think that going down from 8.1 to 2.3 is just comical. They have their normalized target around 2%. They're like, if we go right back to 2%, we're not going to be credible. So we'll go to 2.3%. That's how they got there. I'm sure there was not an econometric rationale for that. And they looked at where inflation is right now, and it's 9.1. And they thought, if inflation is about this into the end of the year, then we'll probably be at 8.1. So what's halfway between 8.1 and 2.3? It's 5.5. And what do you know? That's where the guidance is for next year. So, I mean, take it with a grain of salt. I think that ultimately they're very confident, and they don't have any other tools. And so they have to basically be confident about it to get that expectation in terms of inflation to come down. So, could this be right? It could be right. I mean, it is very much just if you think that 2% is the long-term run rate, and you think that a lot of these inflationary pressures are short-term in nature, then yes, they probably will be right. I have a tough time thinking that they will be right, though, just because history shows that they haven't been. So 8.1, 5.5, 2.3 over the next 3 years of inflation on the ECB. It'll be interesting to see what happens with that. I would say that overall, I would actually take this as a dovish report. There was commentary on the asset purchase program, which was a little bit more dovish than I was thinking it could be. And the 75 basis points was rather baked in. The euro is not moving much on this news. Tom, what are your thoughts? Dovish, hawkish, somewhere in between?
I just feel like it hit expectations. I mean, there's no splash really either direction, I think. So I would say if a 1 is a hawkish and a -1 is a dovish, I think we came in at a -0.25, just slightly dovish, but closer to neutral than anything.
Relative to, I think, what they're doing at the US Fed.
Yes.
I think it's quite dovish.
Yeah, it's a substantial dichotomy in terms of the messaging and how it's really going to go, because they're not over there saying we're going to destroy the jobs market, whereas Powell is functionally saying that. And I think that's really the difference. I think they really need to squash demand, really are taking the steps. ECB, they're in a completely different ballgame than we are.
Speaking of Jay Powell, just a week or two ago, he was out at Jackson Hole saying that we are going to require some loosening in demand, essentially saying that he expects unemployment rate to go up, and that's a good thing, and that's what he wants to see. We haven't seen that. Do you think that he changes the tune today? He's talking at 9:10 a.m. Do you think he changes the tune today or reiterates that, which would be perceived quite negatively by a market that rallied 2% yesterday?
I think he reiterates it, and we also had the initial jobless claims come out at 8:30, which we haven't touched on yet, and it was a better than expected number. So the initial jobless claims was expected to be 235,000. It came in at 222, and they revised the number down from the last report. And so as a result, what you have there is a positive sign in the jobs market that people are not getting laid off at the rate that we are expecting them to,
or even the rate that we were getting laid off in a month ago.
Yeah, exactly. And so, the question is that another, arrow in the quiver of Jay Powell to set this thing on fire?
And that's the problem. Airlines talking about demand is actually improving right now. That was the big news yesterday out of the airlines. And then the reason the notes are so long today is because we looked through 10 conferences yesterday where CEOs, CFOs spoke, and they all have their transcripts out, and they all talked about what they're seeing in the economy. And things have really stabilized after a lot of fear kind of into July, as inflation began to not come down, but at least taper off just a touch. We definitely saw the consumer just kind of say, sod it, I might have to use credit card debt, but I'm not going to walk away from these purchases. And we've definitely seen demand stabilize. If you're looking at Union Pacific, they said that consumers are under pressure. If you look at consumer sentiment or the political atmosphere, I thought it was interesting that he pointed that out. But intermodal is up 1%. Automotive is just kind of leading the pack up. There's a big rebound in automotive right now that's kind of interesting to watch, part of that supply chain. And then for the positives for Union Pacific, they also see that they're gaining market share, and they say they're pretty confident about their own growth. And then if we move to the consumer overall, Disney saying that demand is robust. That was the term that they used. They continue to see an acceleration of core subscribers heading into the fourth quarter. And on the parks, which I would think is ground zero for where you might see some economic weakness if those consumers don't have the money to spend, they're continuing to spend. And they're reiterating what they said on the earnings call 2 months ago, that the demand pipeline looks robust. Lots of hotel bookings, lots of cruise ship bookings. And they say that they actually have room to grow even further on the cruises. AT&T, the CFO came out and said he was a little bit surprised by some of the headlines that were reported after the last earnings call when he said that people are taking longer to pay their bills. He said, look, we're back to, they're paying at the same rate they were in 2019. And we're actually getting some price increases there. And then Constellation Brands, the maker of Corona, Modelo, their volume continues to grow significantly. They're looking at higher margins, and they say, quote, trends continue to be robust. So overall, on the consumer side, relative to expectations and relative to where we were just a month or two ago, there has been some stabilization in that market. I would caveat that and say for now, but that's the state of the market as it stands, and that's the information that we got from CEOs and CFOs. And I think that that's a fairly good indicator of where Q3 earnings might go, considering that we only have 2 more weeks left in the quarter, 3 more weeks.
Yeah, I think, I mean, notably on the AT&T, they're seeing international roaming, which is a big money maker for them. Specifically in my case, in the last week, having to pay to have service over there. I mean, I think one thing is that expectations changed a lot over the last couple of months too. We saw the run up in the market, through the end of July and August. And I think that, like anything, trends are not linear, particularly when it comes to the market. So we saw, a little bit of a downtrend. We're taking a breather. I think the question is, where are we going to go from here? But my expectation is with the Fed raising rates, we're probably going to continue that downtrend. How quickly that kicks back in is sort of remains to be seen. But, definitely in the next 6 months, I think we see another round of things like people not paying their phone bills, or, a little bit more dampened expectations. But it's nice to see that at least we've stabilized for the time being.
Yeah, I would agree with that. Semiconductors, I think it was probably a little bit worse than prior reports. Intel came out and said that it's pretty rough out there. They do say that they're shipping below the consumption rate in the end market, and they say that they do think that this will be the bottom, which is a very bold call for them to make. But they're reiterating what they said a couple months ago in terms of that. But they said in the near term, it's worse than expected, which also fits with what we saw from NVIDIA. And essentially what we're seeing especially in the PC market, is that a lot of inventory is coming out of the supply chain. A lot of OEMs are slowing their builds. And what this has is it has a greater, what they call it, a bullwhip effect at the higher end of the supply chain. So if you're providing the chips that go into the computers that then get shipped to the OEMs, then they get distributed, then get retailed. The further you go up in that supply chain, all the way up to the semiconductors, you're going to have an outsized impact. Even if the end demand goes down 1% or 2%, the bullwhip effect means that you might be down 15 or 20% at the top of the supply chain. And so that's what the semiconductor companies are basically saying right now. If you're looking at Intel and NVIDIA, my concern is that if end demand actually falls, then you're going to have more significant ramifications for the semiconductor companies. I would say a little bit more cautious on the semiconductor side, but they're reiterating what they said before. On healthcare, they did note China's a headwind. The Johnson & Johnson medical device president was asked about that, and he sees headwinds in China going all the way through 2024. So for international companies, that could be significant. And then on utilities, the Inflation Reduction Act is kind of transformative. We invest in a company called Next Era. Many of you might have it in your portfolios. And they were at the conference as well. They said the IRA is transformative. I think it is difficult to overstate how impactful IRA will be for our industry. And this makes a lot of sense as people move from refined products to running their vehicles on electricity. That electricity's got to come from somewhere, and it's going to come from the utilities. Tom, you have any thoughts on that?
Yeah, I think it makes sense. I mean, that's probably the one shining piece of the Inflation Reduction Act that helps, is that it basically allows these companies the runway to make the changes necessary. Before, it's like, if I'm a utility company, I'm making plenty of money in natural gas or coal, creating electricity. It doesn't really make sense for me to just go out on a limb and say, hey, I'm going to really invest in solar. I'm really going to invest in all these renewable energy things, especially because they're exceptionally expensive. So if you reduce the cost, make it more available, make funding more available for them to do that and build out that infrastructure, it takes the pressure off the company. Because we can basically stay here and do this and be profitable, or we can try and do both and we'll be less profitable, which is going to hurt our stock price. potentially hurt the business, basically opens that door and says we can now do what we need to do to have a dual type of attack, which is the renewables and the non-renewables. So I think it's very beneficial. I think in the long term, it's going to help, and that does ease the path there. The question is, how quickly does it work? How effective is it going to be? How are some of these things going to really improve the grid, and how long is that going to take?
Yeah, I agree. Today we have a number of companies among the Home Depot and General Motors, which I'm going to be very interested in. We do have Analog Devices and Pfizer who are going back to back in terms of the conferences. But we want to close out really quickly with the Apple Far Out event that was announced yesterday. Few updates: iPhone, Apple Watch, AirPods Pro Series 2. The iPhone release was not a big deal, I think. When you look at new features, they're not going to have a physical SIM card anymore. They have a better camera on the iPhone 14 Pro, but by and large, there's not a whole lot of change there. They will have satellite connectivity on the iPhone 14 Pro, and that'll cost about $1,000. I think the implication here for the stock is that these phones are releasing a little bit earlier than they did last quarter, this time last year, which should set the stage for better earnings, because you're going to have more weeks, more selling days where you can actually sell the new higher price phone at greater volumes. You also had the Apple Watch, where they announced the Apple Watch Ultra, and then the revamped AirPods Pro with better noise cancellation. Tom, is there anything that you're particularly excited about here, or something that you're keen to get, or that you just need to replace?
I mean, I'm a big time Apple stan. I've got the whole suite, the watch, the phone, the AirPods.
I'm even because my charger is now defunct, I am currently using Tom's wireless charger to charge my phone.
Yeah, I've got the magnetic wireless charger thing. I mean, all their stuff is great. It all works. I like the new watch. I mean, for those of you who are in the know, there's a lot of running competitions that happen inside the office, and Ben and I are meticulous about tracking when and how far we run. Ben is a much faster and longer runner than I am, but that kind of stuff, the quantified self stuff you can get out of the Apple Watch is very cool. And I think the highest end, the Ultra one, looks like it's going to be awesome. Do I feel like running out and spending $800 on a watch I've already got? No, but eventually this one's going to die. I've had it for 4 years. And that would probably be the one thing that I would replace, just because I love it. I love the watch. It's awesome. And this new one looks pretty sick.
Yeah, that's submersible to 130 feet. It's got,
for all those times of 130 feet underwater.
It's
very useful.
If you like that, Casio, that old, the Casio, the one with the calculator, those watches, you're gonna love the Apple Watch Ultra.
Yeah, or if you like Dick Tracy, which is a big time throwback.
Yeah,
communicator watches.
Yeah, I mean, that would be awesome. It is $800 though, so
yeah,
trade carefully. As for me, as I won't be able to run the new iOS, if you have an Apple Watch that's Series 3 or earlier, that doesn't work. I will have to upgrade, and I'm gonna buy the cheapest one, the Watch SE, which doesn't have a blood oximeter, doesn't have a temperature thing, but I'm just fine with that.
Yeah. How often do you know your temperature either?
Yeah, and COVID's done, so at least at least as far as I'm concerned. With that, we'll leave it there. We'll be back tomorrow. We'll give you an update on Jay Powell, ECB, and close out the week strong. And we'll see you tomorrow morning. Bye.